Would you consider a 10% return on your money a good return in real estate? Maybe. How about a 15% return? Not bad. 20% sounds even better, right? Well, what if I told you that there is a real estate investing strategy which, when done right, can give you an infinite return? Not only that, but it is extremely scalable, and it is the same strategy that has allowed me to go from 9 rental units in 2017 to over 120 units today. I am, of course, talking about the BRRRR strategy, but with a few very specific features which I'll explain in this installment of my Chalkboard Real Estate Investing series. Let's get right into it. As you may know, BRRRR stands for Buy, Rehab, Rent, Refinance, and Repeat. It is a real estate investing strategy made popular by Brandon Turner of BiggerPockets. Here's how it works. The first step in the BRRRR strategy is to find a distressed or undervalued property that has the potential for appreciation. This could be a fixer-upper, a property that has been mismanaged in some way, or a property located in a high-growth area with a lot of potential upside. Once you've purchased the property, the next step is to renovate and repair it, or oftentimes simply to reduce its expenses and to increase its rents beyond what the prior owner was willing or able to do. The repairs can include everything from cosmetic updates to major capital improvements. The goal is to bring the property up to market standards so that it can attract high-quality tenants at higher rents, while at the same time reducing the operating costs. Once the property is fully updated and ready for tenants, the next step is to find and screen tenants. If the improvements you make to the property are done strategically with the end goal of attracting higher-paying tenants in mind, it shouldn't be very difficult to find good tenants and increase the property's gross income. After you've successfully rented out the property, the next step is to refinance it and pull out some of the equity that you just created through improvements and reductions in costs with the intent of redeploying the capital on the next deal. This is known as a cash-out refinance. The final step in the BRRRR strategy is to repeat the process by finding and purchasing additional properties, improving them, renting them out, and refinancing again to pull out the equity. Now here's the secret sauce that can make this strategy so powerful. Instead of using your own money to buy the property, you use borrowed money. Instead of paying market value on the MLS, you find off-market deals that you can buy at a discount. And finally, instead of using traditional banks to refinance the initial loan, you use a portfolio lender who will not place a limit on the number of loans you can do, so that you can continue scaling your portfolio with this strategy quickly and without artificial limits. Now let me elaborate on each of these so it's a little bit more clear. First, the financing. If you're looking at a non-owner occupied rental property and you want to borrow money from a financial institution in order to buy it, you will have to come up with some money out of pocket in order to get it. The financial institution will typically want you to put up a percentage of the purchase price using your own funds, usually anywhere from 20 to 30%. They also won't be too keen on you borrowing money to cover the down payment and likely wouldn't allow a second position lien. If you need funds to cover the rehab, they may lend them to you with a construction loan, but they will usually release the funds in draws, which will require you to front the cost of the rehab to meet each construction milestone, and then you would get reimbursed from the draw that the bank gives you. And if you're thinking that you will have better luck financing the purchase and the rehab with a hard money lender, you'll also be disappointed. Most hard money lenders will also want you to have skin in the game. They will approach the funding of the purchase price and the rehab costs very similarly to banks, often requiring you to put down a decent percentage of the costs. But in addition to that, they will also likely charge you a higher interest rate and a lot more fees than a traditional bank. This creates a bottleneck with the BRRRR strategy, limiting your ability to have several BRRRR deals going on at once because you likely won't have enough available cash to cover the down payment and the rehab costs on more than one deal at a time. For this reason, most investors who try to follow the BRRRR strategy usually can only handle a deal or two at a time and have to wait 6 months to a year for the rehab and the refinance process on the first deal to be completed before they can buy another deal. So what's the answer? How have I been able to buy multiple deals a year every year for the last 5 years and rapidly grow my portfolio? The answer is I use private lenders. Unlike hard money lenders and banks, private lenders are 100% about relationships and their investment in you as the operator and developer as opposed to any particular deal. All of my private lenders are individuals who have money to invest, who want an above average return on their investment, and who know, like, and trust me. It took me a lot of time and effort to develop these relationships, and it took time to build a track record to show them that my business partner and I know what we're doing. But once I did, I was able to get 100% financing for not only our purchases, but the rehabs as well. This has allowed me to buy multiple deals per year and to continuously add 25 to 30 units to my portfolio each and every year. The second key to this strategy is paying below market prices. The saying goes that in real estate, you make most of your money when you buy rather than when you sell, and that's absolutely true. If you overpay for a property, no matter what you do afterwards, you'll be hard-pressed to make up the deficit that you put yourself into from the start. In order to successfully execute the BRRRR strategy in a way that provides you with an infinite return and a continuous opportunity to grow the portfolio to the size you want it to be, you need to make sure that you buy the properties at below market prices. The farther below market, the better. The way you get properties at lower prices is by looking for situations where the owners need to sell and by speaking with these owners before they put their properties up for sale with realtors on the MLS. The third key to this strategy is refinancing your private money loan with a financial institution that doesn't place any arbitrary limits on how many loans you can have. It's long been the topic of discussion in investor circles that conventional financing caps out at 10 loans that an individual can have in his or her name at any given time. Obviously, that's pretty limiting if you're trying to build a 100 or even a 50 unit portfolio comprised of small multifamily properties, which are the most abundant and the most accessible for average investors. The way I solve this problem is by using local community banks and credit unions, which don't resell their loans on the secondary market and which don't have to abide by the 10 loan limit. Furthermore, I go through the commercial departments of these local lenders and get commercial loans, which tend to have even more flexible terms and which focus much more on the assets rather than the individual owners. Part of the reason I do this is flexibility, and the other part is because I hold all of my properties in LLCs, which are only eligible for commercial loans. Since I don't use any of my own funds to buy and rehab the deals, and since I buy below market and increase the property's values, even at 80% loan to value at the time of refinance, I am able to pull out enough equity to pay back the private lenders. This means that I get to hold on to cash flowing properties with zero of my own money invested and at least 20% equity after the refinance. So my return on investment turns out to be infinite. There are obviously a lot of other nuances to the strategy, not the least of which is the rehab, which requires knowledge of construction, which luckily my business partner is very good at, and also having reliable and inexpensive contractors. There's also the part about managing the rental properties effectively and making sure you have a great team. But those are all topics for another video. The bottom line is, I would say that the BRRRR strategy is definitely not a strategy you take on as a brand new investor. But with a little bit of experience and track record, this is one of the most profitable strategies out there. Thanks for watching this video. If you got value from it, please leave a like, follow me on social, subscribe if you're watching this video on YouTube, and check out the other videos on my channel where I dive even deeper into various real estate investing topics and concepts.